Welcome to the Snowbirds Expat Radio Podcast. I'm your host, Jerry Scott. Now, before we introduce today's guest and topic, I wanted to make a quick correction on our last podcast with Craig Weir. The episode was called, Should Canadians Consider the Roth Conversion Before Returning Home? Meaning when they have their long careers in Canada and they move back to long careers in the United States and they move back to Canada. Now, to clear up any confusion, Craig asked me if this conversion should be done before they move back to Canada. And I think I kind of got sidetracked, and we were talking about the election that Canadians need to file with CRA with their Roths. And so the answer is yes. In order to do these Roth conversions, you need to be doing it in the United States before you come back to Canada. So on that note, now that we stand corrected, I want to introduce today's guest on our episode and today's topic. And today's topic is going to be the U.S.-Canada Tax Treaty Explained. And our guest today is Mary Beth Lougen from the United States. So Mary Beth, welcome to the show. And tell us more about what you do. Tell us a little bit about your firm before we jump into this confusing treaty between Canada and the United States.
Thanks, Jerry, and thank you for having me. I was excited to get the invitation. So for everybody listening in, I'm the president and founder of American Expat Tax Services. I'm currently located in Virginia Beach, Virginia, but I am a dual U.S.-Canadian citizen, which is how I really got into international taxation. But I was born and raised in the States, and I started preparing taxes back in 1978, so please don't count up those years. And I have 6 kids. It was a great part-time job, helped out with the family finances, allowed me to be there for the kids. But, eventually I earned my U.S. Series 663 and 7. So I worked as a tax-savvy financial planner for one of the large tax offices down in the States. Fast forward a few years, and my husband's job brought us up to Calgary, Alberta, Canada. And that's where I learned my current trade of international taxation, because I had to be able to do my own taxes. I worked as a trainer and reviewer in a very large tax organization for many, many years. And when we left there, I started my own practice, and that's how American Expat Tax Services came around. I've got a very large team of amazing people. A good portion of them are in Canada, and we do prepare U.S. and Canadian tax returns. We're familiar with both tax codes as well as the tax treaty. Now, personally, I'm an enrolled agent, which is the highest designation given by the IRS. I'm also one of less than 300 U.S. tax court practitioners, which means I can practice in the United States tax court with all the rights and privileges of an attorney, but I'm not one. So essentially, I'm not an attorney, I just play one in tax court. I also have a master's of legal studies in taxation from the University of San Francisco School of Law. So as you can probably tell from that, tax has been a passion of mine for a long time. Do what you love and love what you do. And I love the strategy involved in international taxation and how to figure out between the tax codes and the treaty, how to have our clients pay the least amount of tax overall, which I know is something that Jerry does in his firm to make sure people are protected on both sides.
Well, I have to tell you, a mother of 6 is the most impressive thing that you mentioned outside of all the education, because I'll tell you, my mother was a mother of 5, and she was one of the smartest people I've met in my life. I never ever told her that. But she was,
might be nice.
but she did tell me that several times. So that's where it comes from. My mom says she is the smartest person. I better listen to her. Well, that's very interesting. So today's topic, and this is something that every time I talk about the Canada-U.S. tax treaty, I keep on asking, and we can go into all these questions, and I'll have a lot of questions pop into my head, and I'll try and save everything for the end. But the question always comes up, this treaty has not been revisited for a while. And before I go into those questions, tell us more about the purpose of the Canada-U.S. tax treaty.
So the purpose of any tax treaty, they generally have 2 purposes. One is to remove the barriers to cross-border taxation by eliminating double taxation. People don't want to pay tax twice, right? The other is to prevent tax avoidance or evasion by allowing the tax authorities to exchange information with each other. So those are the two primary purposes of any tax treaty, and certainly the U.S.-Canada tax treaty.
Now, when you talk about double taxation, you're only talking about individuals.
No, I'm also talking
Even
about
corporations, even corporations.
Absolutely.
Okay.
Absolutely.
Okay. So the biggest, so when a person, let's dig into this tax treaty when it came out. I mean, I made some notes here, and it goes back a very, very long ways. And I think the last time it was revisited was 2009. And why wouldn't it be revisited more often? I could be wrong on my notes on 2009. Maybe I was hopeful.
It's like in 2007 or 2008 was when the last protocol came out. But tax treaties really don't change very often. And if you look at some of them, now I'm more versed in the U.S. treaties as a rule. I focus more on U.S. taxation, although we do Canadian, and I know enough Canadian to be perfectly dangerous, but my team is amazing, and they know all the details. But the treaties in the U.S., we have some that go back 80 years, haven't been touched. We have other ones that are currently held up in Congress and waiting to be approved. They kind of use them as, what's the right word? They refuse to get them into effect, waiting to get something else for it, right? So they're holding them out kind of as bait for something else. But no, they don't update treaties very often. They don't need to.
Okay. And I guess the reason why I bring up that the treaty and why I used that number of 2009, because in Canada, we came up with this investment product or this shelter called a tax-free savings account, which came into existence in 2009. And of course, it's not mentioned, and there's a lot of confusion among accounting firms to say a U.S. person should have a TFSA, a U.S. person should not have a TFSA. So that doesn't happen very often where Canada comes up with this new product. Do you ever see that being visited where there could be some bend there somewhere, some way, somehow? With a TFSA?
Absolutely. Absolutely. There is a huge divide in the U.S. tax practitioner community about whether a tax-free savings account is a foreign trust for the U.S. That's why they say, U.S. persons who live in Canada shouldn't have a TFSA, right? It's not tax deferred in the United States. And a good part of the community says it requires the filing of Forms 3520 and 3528 every year because it's a foreign trust. The problem with those forms is if you miss filing them, the penalties are just draconian. They start at $10,000 per form. So right off the bat, you're looking at potentially $20,000 of penalties to file a form one day late. That's insane, right? But if you look at the Canada's tax code, TFAs can be set up in three different ways. They can be deposit accounts, meaning they hold cash only. They can be trust accounts, meaning they can hold investments, or they can be set up as annuities through an insurance company. We don't see too many of those. Usually what we see are the TFSAs that have investments. They hold mutual funds, the dreaded PFIC. They have stocks, they have bonds, they have whatever's in it, or they just have cash, but they're set up so they can hold investments. So they signed an agreement of trust when they opened the account. Does that make it a trust for U.S. tax purposes? I'm fairly well connected at the IRS as far as these things go with international. There's a great many people at the IRS that believe every single TFSA account is a foreign trust that requires Forms 3520 and 3528. We've told them they're not because they're not all. But an awful lot of them, they do sign the agreement of trust. There is a contingent, and there has been some positive note by an attorney in British Columbia who says they're not trusts. And a lot of people say under the U.S. rules, and the U.S., if you look specifically at what a trust is in the United States, that a TFSA doesn't fall within that parameter. Therefore, it's not a trust. The rub is if the IRS thinks it's a trust and the IRS is looking for these forms, do you have the ability, the expertise to argue with the IRS if those penalties get assessed, right? In our practice, we explain both sides to our clients, and they make the ultimate decision as to whether or not those forms are filed. Once you start filing them, you have to stay on top of it and make sure they're filed timely. But it's a matter of do you want to take the conservative route, file the forms just in case, or do you want to not file the forms and take the chance that the IRS is going to see what you have, argue with you, and assess penalties?
So as soon as you fill out a 3520 and a 3528, are you basically telling the IRS that it is a trust?
Yeah.
And that's why, okay, so you're almost
you're signing yourself up to file the forms every year, right?
okay. And I think the attorney that you're talking about in Vancouver, is it Max Reed?
It's Max Reed.
Oh, yeah.
And there's another attorney in Toronto, John Richardson, who has very, very good points as far as it not being a trust as well. He agrees with Max Reed. I've read Max's stuff, and I think it's on point. It's well written. He's got great points. But if the majority of the IRS thinks it's a trust, do you have the expertise to argue with the IRS? Are you comfortable putting it's a matter of personal preference and what's your risk tolerance?
Yeah. And that's why
easy. It's just not easy. And the IRS will not clarify this for us. They just won't do it.
And this is why we always default on the wealth management side. We always default to the accounting firm. If your accountant is telling us that it is a trust, that's fine. If you should have a TFSA, great. If they're telling you that you shouldn't have a TFSA, we're going to take that side of the argument as well, because we don't want to be in a position to go against anybody's accountant, because that's what they do. They file the proper forms, and away we go. So I guess my question is that they'd be able to solve this if they included a TFSA, and I think the RESPs come up as well too.
Mm-hmm.
Under the treaty or the trust issues.
No, they're not in the treaty, but they are in the is it a foreign trust realm?
Okay, and they're saying once again that it isn't, or it is.
No, RESPs absolutely are, because they're held for the purpose of preserving income for the child or for the beneficiary, right? The good news is that for RESPs, the IRS back in 2020 released a revenue procedure 2020-17 that accepted or exempted certain types of accounts from having to file forms 3520 and 3520A each year. RESP, the Registered Educational Savings Plans, fall squarely within that revenue procedure. So you don't need to file a 3520 or 3520A if you have an RESP. They're not tax deferred. You still have to report the income on the return, but you don't have to file those forms. Tax-free savings accounts do not meet the criteria to be accepted from filing forms 3520 and 3520A.
And I guess what we've always done with the RESPs is we've just made sure that the subscriber was a Canadian, and that would allow you to get away from all these issues whatsoever. Solely Canadian, not a dual citizen, but just a Canadian citizen. So let's talk about this treaty for a second.
Sure.
How important is it for the average person to really understand that treaty if you are spending so much time, even if you're just a snowbird and you have your residence down there and you're spending less than 182 days a year in United States? How important is it for the average person to be familiar with the treaty?
I think everybody who has cross-border taxation has, income and assets in more than one country. I think everyone should be familiar with their treaty. But that being said, there's a lot of nuance and detail to tax treaties. And just on a bold-faced, plain reading of the treaty, a lot of people don't get it right. So there are some things that people just need to understand about how to read a tax treaty. And I know we'll probably talk about this in a little bit, but the savings clause is one of the most important clauses in the tax treaty when someone is trying to get familiar with what this document will allow them, what provisions, what benefits it will allow them. They just need to know if the document actually pertains to them.
Okay. And one of the most important parts of the treaty is, like you say, is the foreign tax credits.
Foreign tax credits, absolutely. But foreign tax credits are also allowed under the tax code of both countries. So they're not exclusive to the tax treaty. But there is a article that deals strictly with foreign tax credit.
Okay. This is some of the other things that I think about when I talk about this treaty. Now, I think the biggest thing that we have concerns about is that some of the states, and just to name a few, California, Maui, do not recognize the treaty. Can you go into greater detail what they say when they say they don't recognize the treaty? What does that mean for a Canadian living in the United States?
Sure. And let me just back up one step before I talk about the states. There's one other thing that people should be aware of, that Canada makes invocation of the treaty mandatory. If there is a treaty benefit that's going to lower taxation, Canada requires you to use it. The US, it's not the case. The treaty in the United States is completely optional. You're not required to use it. You can use it one year and not use it the next. So that gives you some opportunity to be able to change things and change your taxation between the two countries and sourcing and who's giving the credits. And it gives you opportunities, right? Where we have that kind of opportunity, you can really move some tax numbers sometimes, not always. Now, as Jerry said, the states are not required to honor the tax treaty. Most of them do, but there is a handful of states that do not, which means that regardless of what the tax treaty says, the state is just going to tax you as the state is going to tax you. California is notoriously bad for this. In fact, California disregards certain portions of the Internal Revenue Code. I appreciate the fact they're very upfront about it, and they're pretty easy to find out what sections of the code. They don't recognize PFICs. California will not recognize sections 1291 to 1298 of the U.S. tax code. California also doesn't recognize RRSP accounts as being tax deferred. They treat them like brokerage accounts. So states are not required to give you any provision that's in the treaty. So in those cases, you can find yourself double taxed, especially if it's between, say, California and Canada. They will not give you credit for any taxes paid to Canada or a Canadian province.
So why do they look at pension plans? So let's say, for example, in Canada, you have this pension plan, you move it into a locked-in RSP. Why don't they're okay with a locked-in account, but they struggle with an RRSP?
Your guess is as good as mine.
Well, I can't even guess.
I don't know if it's a cash grab. I don't know if they don't understand. I don't know if they just think there's not enough of them, that this is a problem, that it needs to be addressed. But they don't recognize Canadian retirement plans. They are considered brokerage accounts, and every year you're paying tax to California on whatever goes on inside of that account.
So I guess my next question is, and I'll give you a real life situation with one of our friends and clients that live in Maui here. They have a large RSP, same age as myself, 62 years of age, will not touch this RSP until age 71 when they convert it to a RIF. But in the short term, when they left the country, when they left Canada, they didn't crystallize the gain in the RSP. And they have a large gain. So we know that federally it won't be taxed, but at the state level, I believe this federal tax rate, and once again, I'm not an accountant, but I think the federal tax rate in Maui is 11%. So they would basically be paying, they'd have to disclose 11%. They would have to pay tax on interest, capital gains, and dividends on a yearly basis. They have to file their tax returns. So when they go to file their tax returns, I guess it's just like your regular 10, is it 1041? Yeah.
A 1041 is like for states. So a 1040 return is personal.
Oh, 1040, I'm sorry, 1040. So they would just have to declare all that interest, capital gains, and dividends in their state returns. Yeah,
they would. So a good strategy would be to put investments in there that don't create income on the annual. They're just, mostly capital appreciation. If the person has that risk tolerance, because I know that's mostly growth area stocks that do that.
Yeah, exactly. So as long as there's no dividends or capital gains that could be taxed at a higher rate.
Right.
Now, how often does it come up when a person is an American has been in Canada for the last 30, 40 years, now they want to move to the United States? It really comes down to they have to start looking for states that don't have state tax and states that recognize the treaty. Is that what it's coming down to? So
It depends. It depends on what their income type is, right? And what the credits are going to look like. So that answer just, it depends. If they're retired and they're looking predominantly at pension income, probably.
yeah, yeah. So getting back to the treaty here.
Sure.
So how often does Canada, United States, so this is something that's being discussed all the time. Do they ever see wholesale changes to the treaties? Because I would say 10 years ago, people like yourself and advisors being licensed on both sides of the border, there might have been a handful. And now the space has grown so much with people, Americans moving to Canada, Canadians moving to the United States. Is there a real need to explore this treaty and maybe tidy it up a little bit?
Actually, the US-Canada treaty is one of the best treaties out there. Some of the other ones are pretty brutal. The Canadian-US treaty is actually really solid. And no, I don't see them addressing it anytime soon because they shored it up quite a bit and made it very, very friendly to pensions, cross-border pension, Canadians putting into US pension plans and US putting into Canadian pension plans and allowing deductions for the amount you've put in. And they've really made it one of the best treaties out there. I can't think of a treaty that offers more benefit than the US-Canada treaty, to be real honest with you. Some of these other ones, they're so archaic and so old that they're just pretty much useless at this point.
Yeah, and I guess for a lot of Canadians that do move down to the States, the treaty doesn't really come into play too much because they are going to, they could exit Canada and never have to file another tax return again. And all they have to do is worry about US tax.
That's correct. That's correct. They can. But, it is possible to be resident in both countries. And where you're resident in both countries, you can find some benefit in the treaty. And again, a lot of it depends on where's your income coming from? What type is it? Where do you really find that you may have some double taxation issues?
Okay. Well, we're finding this more and more often now that you're seeing people that almost, I know there's tie-breaking questions and tests that determine which is your main residence, but we are seeing Canadians that are dual citizens that do live in parts of the States and spend as much time up in Canada. I mean, obviously the treaty is very important for them more than anybody.
Well, none if they're citizens of both countries, right? Well, if they're citizens of the US, they're always going to be a US tax resident.
Yes.
But you can use the tax treaty if someone has a green card or if someone is not a US citizen, they just have a visa or they don't have a visa. You can use Article 4, which is the residency tiebreakers, where a taxpayer, where a person is a resident of each country, of both countries under the respective tax codes. The treaty tiebreakers allow you to assign residency to one country and not the other. So yes, where you have people that are, Canadians that are coming down into the States like the Snowbirds, and let's say they accidentally spend more than 182 days in the States, and they want to remain a non-resident of the United States. Well, they cannot do it under closer connections, which is what normally Snowbirds do. They file Form 8840. They're allowed to stay a non-resident under the tax code. Well, as soon as you have 183 days or more in the US, you cannot use closer connections. So you go to the treaty and you do the tiebreakers. And you do the tiebreakers in order. The first tiebreaker that you meet is the one that wins. You don't get to go down the list and pick the one that you like. So the first one is a permanent home. Do you have a permanent home in one or both or neither countries? If you have a home in both, you move to the next, which is center of vital interests. And that's more of my bank accounts are here, my family's here, my furniture is here, I've registered my car here, I'm registered to vote here, that type of thing, right? And usually you can pick someone's residence on center of vital interests. If that doesn't work, you go down to abode, which is more of a day counting test in each country. If you still can't make it happen, if you still have a tie, then you move to citizenship. If they're citizens, then you move to mutual authority. But you can usually assign it that way. And let me just point out that if someone, let's say a snowbird, has spent too much time in the US to use closer connections and they have to go to the treaty to remain a non-resident, they file the return, a non-resident return. This treaty exclusion from residency, this, choosing the treaty to be a non-resident, is only for the purpose of computation of income tax. It is for no other purpose. As soon as they cross that line, they now are filing the FBARs, if they meet that filing threshold, the foreign bank account reports. They're also filing any of the other forms that U.S. citizens and green card holders are required to file. Form 5471 for ownership of a foreign corporation, 8865 for a foreign partnership, 3520s and 3528s. They're now subject to all of that information reporting just because the treaty doesn't cover that. They're only using the treaty for computation of income tax. Now they still have to do all these other forms if they have the requirement.
There's a really big trend out there that you see a lot of immigration firms or these Canadians that do like to spend as much time as they can in the United States. They're saying buy an investment, invest the dollars, get an E2 visa. And that is probably the number one thing that immigration firms are doing. We've had lots of guests on our show, and these are great people. And we've gone through that process ourselves because of the apps we have and the podcast. We want to make sure that we are compliant. But this E2 visa is probably going to cause a lot of confusion for a lot of people, too, when it comes to filing their taxes.
Oh, absolutely. And the E2 visa, they don't get a special exemption. So if they meet the day counting test, known as the substantial presence test, which is a 3-year weighted day counting test to be a U.S. resident, they're going to be a U.S. tax resident unless they choose to and can qualify under the treaty to be a resident of Canada. But yes, just because you have an E2 visa, you still can become a U.S. tax resident if you spend enough time in the U.S.
Is there another issue that as long as we spend less than 182 days in the country in that year, that as long as you're not spending 182 days in that one, that's more of a tax issue on the U.S. side, I believe, as well.
Well, to be able to claim closer connections, you mean?
Closer connections is 183 over 3 years. I'm just saying 182 days. Oh, so it's still 183.
No, closer connections is where you are in the United States less than 182 days during the year, and you have a closer connection to another country. So that's like Snowbirds. Substantial presence test is a 3-year weighted day counting test.
Yeah.
So the issue with closer connections when you have an E2 visa is one of the requirements to file Form 8840 and remain a non-resident is that your tax home is outside the United States for the entire tax year. If you have an E2 visa, that's not going to be true.
Okay. Well, there's, like I say, there's so many people getting the E2 visa this day. That's the number one visa. And of course, that visa doesn't lead to citizenship whatsoever, but I guess it really does open the door for a lot more filing requirements. Now,
well, it does, but that may not necessarily be a bad thing, right? If you're filing worldwide income on your Canadian return, just doing the same in Canada, and then it's just sorting out who gets to keep the tax money. The problem, of course, lies in the additional filings with FBARs and the international information returns.
Okay. Now, one of my colleagues, Carson, which you've talked to a few times, mentioned that you're also teaching in universities. You're teaching a lot of the students. Is there designations, or is there just more and more people getting into this cross-border space?
There's a lot of people trying to get into the cross-border space right now, and a lot of people are looking for mentors. I teach a lot of conferences, and I do teach strictly international. The problem is that, when I started, and keep in mind, it was a long time ago, back when I started and started learning this trade, the IRS was not imposing these really large penalties. So we could make all kinds of mistakes, and we could fix them without worrying about the penalty assessments. That's not the case anymore. So for somebody new coming into the cross-border taxation space as a practitioner, it's frightening because everybody's very busy. Anybody who does this is any good, we're busy. We work year round. And to take someone to mentor them, you just don't have the time, right? So it's very, very difficult for the new people to come in and to get good quality international tax education. It's hard. There's just not a lot of it out there.
Well, I have to say on the cross-border space as an advisor that's licensed in both Canada and United States. There's a lot of people getting their Series 7, which allows to products in the States, but it's very confusing. I would say this podcast we've put together was kind of a year now. I think we're over a year now. We've had so many wonderful people. I'm learning more through the podcast than I could ever learn through an exam, or, we've done the chartered retirement planning in the United side. We've done the financial Canadians, but this cross-border space is so confusing. And I would say this podcast has been a great source people that are listening to the show, but for myself personally, having the opportunity to spend with Mary Beth, and may it be Oliver Branch, who's an immigration lawyer with Moody's out of Toronto. The information that we're learning is just unbelievable. And it is intimidating, like you say, for people coming into the space. The life is going forward.
Yeah, the liability is huge. And I would recommend to, anybody who's listening to this podcast that uses a cross-border professional for financial advising, for immigration, for tax, check out, make sure that they have the right credentials, make sure that they actually know what they're doing, because we end up doing an awful lot of cleanup for an awful lot of firms that they say they do international, but they clearly don't, and it's really ideal if you can find somebody who specializes with both countries. My country, our specialty is US, Canada. So we know both tax codes, we know the treaty, we know how everything interacts. That being said, I have clients all over the world, but US, Canada is my sweet spot. So you want to find somebody who knows that so they can really give you the best overall outcome.
Well, we've talked about all these podcasts that we're going to, not podcasts, but we always say the podcast leads into a webinar. But one of the webinars that we really need to do is, okay, you've got your E2 visa, you get to spend more time in the States. Now what? And I think this is where Mary Beth will be very, very helpful to show people what are the filing requirements, because it's like everything you do. If you want to make sure your immigration lawyers are talking to your accountants, and your accountants and immigration lawyer is talking to your cross-border advisor. And if these people are not communicating, the advisor is not licensed to, as an immigration lawyer or a cross-border accountant. You want to make sure that these people are communicating on your behalf. So I think that's going to be one of our, I was telling everybody, we have this technology on the Snowbird US Day Tracker app, which, that tracks the 3-year, the current year, and the 2-year look back for the closer tie test. We're building a feature where it's going to be able to pop up on a webinar coming up, and we'll use the podcast as a little bit of a tidbit. There's a Canadian term, the tidbits are sold at Tim Hortons, those little donut holes or whatever you want to call them. But we want to make sure that people are educated and they are getting the right people. This is something, going on the internet and doing this yourself is so tough, because not everything on the internet is true. So I think we're going to, we've got enough from today's podcast to scare people, to worry people, and make sure that they're able to give Mary Beth a call. So Mary Beth, what is the best way for people to get a hold of you?
The best way is to go to our website, and it's www.amexpattax.com, AMEXPATTAX.com. Or you can call me. My number is 888-243-9992, extension 301. So you can contact us through either the website, or you can give me a shout. I'm usually always around, especially this time of year. Don't get too many days off.
Well, we appreciate your time, and we have to end every podcast with what is becoming very popular in today's world, or should be popular in today's world. Be kind to all, the world is small. So thank you for your time, Mary Beth.
Thank you for having me.